20.1% annualized operating return on average common equity. I mean, if you are modeling RenaissanceRe right now, that is the number staring back at you.
Oh, absolutely. It's a massive anchor.
Right. We're going straight into the Q2 2026 reporting data today. We're looking at $654.2 million of net income available to common shareholders. Operating diluted EPS came in at 12.92.
Huge numbers.
Yeah, and gross premiums written hit $2.99 billion, while net premiums earned landed at $2.19 billion.
I mean, those are just massive headline figures for a second quarter. And like you said, that 20.1% operating ROE, that's the undisputed anchor of this entire report.
For sure.
Generating that level of profitability in a global reinsurance environment that is, currently fraught with systemic risks, it demands a much closer look at the actual mechanics driving the company right now, because
Right.
it is a highly engineered result.
Exactly. So the mission for this deep dive is to reverse engineer exactly how they achieve that massive margin. We're going to walk through the raw details of this Q2 report, taking a look at segment performance, the underlying drivers of those margins, management strategic commentary, and of course the notable risks they're flagging for the back half of the year.
Yeah.
We really want to show you exactly how the engine over at RenRe is currently functioning.
It is a really complex machine, but the mechanics this quarter become incredibly clear once you sort of separate the components. The core narrative here is really how management is actively balancing this fierce underwriting discipline against an incredibly aggressive capital return strategy.
Right. So let's break down RenaissanceRe's three main profit engines, because they explicitly track their business across three distinct drivers.
They do, yeah.
For Q2, underwriting income was a heavyweight, generating $599.1 million. Fee income brought in $83 million, which is supported by their management and performance fees in joint ventures like DaVinci and Vermeer.
Right, those third-party capital vehicles.
Right. Exactly. And finally, net investment income contributed a really solid $432.5 million to the bottom line.
But the underwriting income is always the heartbeat of a reinsurer, right? And the underlying metrics there are what really make this quarter stand out.
Okay, let's unpack this, specifically looking at the combined ratio, because they reported an exceptionally strong overall combined ratio of 72.8%.
Which is just staggering.
It really is. To contextualize that for you, think of it like a traditional retailer keeping over 27 cents of pure profit on every single dollar they take in, and that's before even factoring in their investments. In the current global risk climate, holding a combined ratio at that level across a multi-billion-dollar book is, it's a masterclass in margin protection.
It is a phenomenal operating metric, but as analysts, we really have to isolate exactly why the margins are that wide this quarter.
Right, what's driving it?
Yeah, so looking at the consolidated data, it's essentially a two-part equation. First, they benefited from remarkably low current year catastrophe losses.
It was just a quiet quarter.
Exactly. A quiet quarter for major natural disasters hitting their specific layers of risk. But the much larger driver here was a massive $199.4 million boost from favorable prior year development.
Wow. Almost $200 million just from prior year releases. That creates a massive earnings cushion. If this quarter had seen like a cluster of severe storms, they could have essentially relied on these prior year releases to smooth over the turbulence on the income statement.
That is the ultimate value of conservative actuarial work.
Right.
When actuaries set IBNR that's incurred but not reported reserves after a major catastrophic event, they are modeling for a really wide range of outcomes.
Right, they have to plan for the worst case.
Exactly. And if they over-reserve when the environment looks bleak, basically locking away capital for worst-case scenarios that ultimately don't materialize, they eventually get to harvest the benefit of that discipline.
Because the claims settle out favorably.
Right, the claims settle out favorably, and that reserved capital flows straight back into the current quarter's earnings stream.
But that 72.8% consolidated figure, it kind of masks a severe divergence when you split the book apart. The overall performance looks pristine, but looking at the company's two core segments reveals two completely different operating environments.
Oh, absolutely. The property segment is really where we are seeing the most aggressive internal reshaping of their portfolio.
Yeah, gross premiums written in property actually dropped by 10.4%, pulling the top line for that segment down to $1.55 billion. The report specifically ties that drop to rate reductions in the catastrophe class.
Meaning they're pulling back.
Yeah, they're writing less premium because the pricing in the market simply isn't meeting their internal hurdle rates.
And they explicitly noted they were finding some partial offsets in other growth opportunities, but they absolutely refuse to chase top-line revenue if the rates are deteriorating.
Right.
The net result is a highly intentional shrinking top line in property.
Yet despite bringing in less premium, the property segment put up a staggering 27.1% combined ratio. I mean, a number that low almost looks like a typo in a standard earnings report.
It's unheard of.
It is. A huge portion of that margin was fueled by $132.7 million in favorable development, stemming from large loss events spanning all the way from 2021 to 2025.
Right, so 5 years of catastrophic events finally settling out much better than RenaissanceRe's models initially projected. Releasing those reserves depresses the combined ratio for the current quarter, making the current underwriting profile look wildly profitable.
Which it is.
It is a brilliant result for sure, but investors need to understand that a 27.1% ratio is heavily aided by historical prudence, not just current year pricing.
Contrast that property performance with the casualty and specialty segment, or CNS. The environment there is radically different. In CNS, gross premiums also fell, dropping 14.6% to $1.44 billion.
Right.
But their combined ratio spiked to 103.3%, which translates directly into a $43.5 million underwriting loss for the segment.
The pricing power and loss trends in casualty and specialty are incredibly difficult to navigate right now. And this is where the nuance of modern catastrophic risk really shows itself.
Okay, hold on. Looking at the CNS numbers, there is a highly specific detail in the report that really stands out. They booked a $54 million adverse development related to the Baltimore Bridge collapse.
Yes.
But they didn't just discover this loss out of thin air this quarter. The data shows they shifted this previously reported loss estimate from the property segment over to casualty and specialty.
That's right.
So I have to ask, is this just internal accounting gymnastics to protect that pristine 27.1% margin in property? Or does a physical bridge collapse genuinely morph into a specialty casualty claim over time?
What's fascinating here is how this reflects the reality of modern catastrophe modeling. When a major piece of infrastructure like a bridge collapses, the immediate, highly visible consequence is physical damage. That is a classic property law.
The bridge is literally in the water.
Exactly. But as the debris is cleared and the physical damage is accounted for, the claims landscape fundamentally evolves. You start seeing massive supply chain disruptions, business interruption claims from the port, professional indemnity lawsuits against engineering firms.
Wow.
And complex liability litigation. Those are all long-tail casualty and specialty lines. It is not accounting gymnastics at all. It is the reality that the liability tail of a disaster is often far more complex and far more expensive than the physical rebuild.
That perfectly explains the massive tail on these liabilities and why predicting the final financial impact literally takes years. The estimates have to jump between internal corporate segments as the lawsuits get filed, and the true nature of the economic fallout reveals itself.
And this complexity is exactly why CEO Kevin J. O'Donnell's commentary in this report focuses so heavily on making disciplined portfolio decisions. The drop in gross premiums across both property and CNS is not a failure by their underwriters to sell policies.
That's deliberate.
It is a highly strategic contraction. They are actively shrinking their exposure.
They specifically highlighted significant rate pressure in the cyber market.
Right. The cyber market has seen a flood of capacity recently, which naturally drives prices down. Rather than participating in a race to the bottom to maintain market share, RenaissanceRe is simply walking away.
Just opting out.
Yeah. Furthermore, they are actively purchasing more retrocessional protection across both segments. They are essentially going to the market and buying reinsurance for their own reinsurance book.
So they are putting a hard floor under their downside. They are capping their exposure on the business they do keep, even if paying for that retrocessional protection eats into their top-line revenue.
They prioritize the protection of their capital base above all else.
So they are holding on to premium dollars by avoiding bad risks, which means their cash pile is swelling. That puts immense pressure on their treasury team to generate yield. Let's analyze the balance sheet, because the engine powering this operation isn't just underwriting, it is their $36.2 billion investment portfolio.
That portfolio is massive, and managing it in the current macroeconomic environment requires extreme tactical precision. Net investment income was up 4.7% year over year, hitting $432.5 million.
Solid growth.
But the total investment result was heavily influenced by the movement in realized and unrealized gains. They posted $121.6 million in total gains, but analyzing the breakdown reveals a highly active hedging strategy.
Let's dig into the mechanics of that hedging, because it is certainly not a straight lineup across the board. You have $217.3 million in net gains on equity-related investments, largely driven by equity futures reacting to broader market movements.
Right.
And add to that another $99.9 million in gains from fund and direct private equity investments.
Those alternative and equity gains are performing beautifully, but they really have to because the fixed income portfolio is facing significant macroeconomic headwinds. They recorded $115.3 million in net losses on fixed maturity-related investments.
And the report attributes those fixed maturity losses directly to increases in market yields during the quarter. The fundamental law of bond math is that when yields go up, the price of existing bonds goes down.
Exactly.
So Treasury is letting the rising yields compress the bond valuations in the short term. Additionally, they took a $79.1 million hit in commodity-related investments, specifically pointing to a decrease in prices for gold futures.
So think of the equity and alternative gains as a gyroscope stabilizing the entire portfolio. The overall portfolio has a highly conservative weighted average yield to maturity of 5.3% and a relatively short duration of 3.0 years.
Very tight.
Very tight. The mark-to-market losses on the fixed income side are unrealized paper losses driven by macro rate movements. Because the duration is short, those bonds will pull to par as they mature.
So they're not permanent losses.
Right. And in the meantime, the Treasury team uses equity futures and private market investments to provide the necessary ballast. That entirely offsets the gravitational pull of rising bond yields to keep the total portfolio returns stable and positive.
That highly stabilized cash flow brings us directly to their capital return strategy, which is incredibly aggressive right now. In Q2 alone, RenaissanceRe repurchased $350 million in common shares at an average price of $300.82.
That's a huge buyback.
And they clearly felt that wasn't enough because they went back into the market and bought another $82.9 million in July.
The quarterly figures are large, but the cumulative data tells the real story here. Over the last 2 years, they have repurchased 11.5 million shares for approximately $3 billion.
Wow.
They have successfully retired roughly 22% of their starting share count from 2 years ago.
Shrinking the share count by that magnitude helped drive their book value per common share of 5.7% just this quarter, landing at $264.77. So what does this all mean?
Well,
Buying back 22% of your stock in 2 years is a massive capital outflow. Doesn't that fundamentally signal that management looked out at the global landscape and simply cannot find enough attractively priced underwriting risks? If the market was ripe with opportunity, wouldn't they be deploying that capital into new business to grow the enterprise, not shrinking the overall company by buying their own shares?
it is the defining capital allocation debate in the reinsurance sector right now. You can view it as a lack of external opportunities, sure, but management views it as a strict adherence to their stated primary objective, compounding tangible book value per common share.
And the math proves they are executing that objective flawlessly. Tangible book value per share, when you factor in accumulated dividends, was up 6.2% for the quarter.
They are generating immense value for the shareholders who remain.
Absolutely.
The discipline is absolute. If the prevailing rates in the market, particularly the cyber and catastrophe classes they specifically flagged, if they do not meet their strict hurdle rate for return on capital, they will not deploy capital just to show top-line growth.
They prefer to shrink the equity base.
Yes. Maintaining rigorous underwriting standards while simultaneously reducing the share count is a highly effective, mathematically proven method to drive up per-share value over the long term.
That defensive posture in both their underwriting book and their capital allocation makes a lot more sense when you look at the specific headwinds management is flagging for the back half of 2026.
Oh, definitely.
The cautionary statements in these earnings reports outline the exact macro variables keeping the C-suite awake at night.
They listed several notable systemic risks that they are actively monitoring. The trend toward increasingly frequent and severe climate events is obviously front and center for a catastrophe reinsurer.
Right.
But they also explicitly highlight the compounding effects of sustained inflation, ongoing financial market volatility, and the ever-evolving, highly unpredictable threat of cyber risks and technology breaches.
The strategic actions they took in Q2 align perfectly with these future warnings. They aren't just listing risks for regulatory compliance, they are actively re-engineering the company to defend against them.
If we connect this to the bigger picture, the entire Q2 report is a blueprint of a company preparing for volatility. They warn you about climate instability, and simultaneously, we see them proactively reducing gross premiums in the catastrophe class by over 10%.
Right, shrinking the target.
Exactly. They warn you about escalating cyber risks, and we immediately see them walking away from specialty exposure due to inadequate rate pricing in the cyber market. They warn you about financial market volatility, and we see them aggressively managing a highly diversified short-duration investment portfolio while actively utilizing equity and commodity futures to hedge their interest rate risk.
So they are systematically shrinking their exposure to the exact global risks they feel they aren't being adequately compensated to take. It is a masterclass in defensive positioning, heavily masked by incredibly strong bottom-line profitability and massive reserve releases.
The 20.1% ROE is the headline, absolutely, but the disciplined contraction of risk is the actual story.
Reinsurance is, at its core, the ultimate business of pricing the unknown. As climate shifts fundamentally alter natural disaster models, and cyber threats become increasingly complex, interconnected, and unpredictable, you have to wonder about the long-term trajectory here.
Yeah, you really do.
Will RenaissanceRe's current strategy of strictly shrinking their exposure to avoid bad risks be enough to maintain these massive profit margins? Or will the pool of so-called safe, adequately priced global risks eventually become too small to sustain their growth engine?
Finding the exact equilibrium between protecting capital and finding avenues for growth is the challenge every investor modeling this stock needs to be hyper-focused on heading into the back half of the year.
Make sure you follow the show for our daily earnings coverage so you never miss a beat on the numbers that actually matter.